Gold lost 9% in a single session. The worst week since 1983. 43 years of history broken in 5 trading days. Silver at 61, cut in half from January highs. While your screen is red and headlines scream crash, I need to show you something they're not telling you. The institutions that triggered this crash are quietly accumulating physical metal at these prices. They crashed it, and now they are buying it. The biggest fire sale in 43 years is not an accident. It is a strategy. By the end of this video, you will understand how it works and what comes next. Welcome to the hidden economy. Hit subscribe and the hype button now. Tell me, are you panicked by this crash, or are you buying this dip? I want to know, because this video is for you. Not for traders or algorithms, but for people owning physical metal. You did not make a mistake. I'll show you why. Let me start with what triggered this carnage. Understanding the cause is the first step to the cure. 3 things hit at the same time. It was their combination. The first trigger, the 48-hour ultimatum. Trump gave Iran 48 hours to open the Strait of Hormuz or face attacks on their power plants. Infrastructure providing electricity to 90 million people. Iran responded as expected. If you attack our power plants, we will block the strait and destroy American energy and technology infrastructure across the region. That is not de-escalation. That is the opposite. 2 nuclear-capable nations threatening civilian infrastructure with a 48-hour clock ticking. The market heard that and panicked. The kind of panic that makes institutions dump everything simultaneously, because a 48-hour ultimatum means in 2 days, either the strait opens or the war escalates to a level that makes the last 3 weeks look like the warm-up. And nobody wants to be holding risk assets when that clock hits 0. The second trigger is forced selling. I need to explain this carefully because it is the single most important reason gold crashed 9% in one day. It is not because gold is broken. It is not because the safe haven trade is dead. It is because of mechanics. The stock market has been hemorrhaging, billions of dollars of losses every day. When stock portfolios crash, margin calls hit. Hedge funds and institutions need to post more collateral or sell positions. And they need cash immediately, not in a week, right now. And when you need $200 million in cash in the next 30 minutes, you sell the asset that is most liquid. The asset that trades 24 hours a day in every currency. The asset that can absorb a $200 million sell order without the market closing on you. That asset is gold. Gold is being sold not because it is worthless. It is being sold because it is the most valuable thing in the portfolio. It is the one thing that can be converted to cash instantly. And in a liquidity crisis, cash is king. Not gold, not silver, not stocks. Cash, dollars. And every institution on earth is scrambling for them simultaneously. That kind of coordinated selling overwhelms every buyer. Every support level, every historical pattern. It just falls until the selling is done. Let me give you a sense of the scale. Gold lost 9% in a single future session. 9% on the world's most traded commodity in one day. To put that in context, the total above-ground gold is worth roughly $15 trillion. A 9% decline in one day wiped approximately $1.3 trillion of value in hours. Not because anyone recalculated the fundamental worth of gold, because margin software at 1,000 institutions simultaneously generated sell orders that no amount of buying could absorb. That is not a market functioning normally. That is a market being used as an ATM by desperate institutions. And silver got hit even harder on a percentage basis, because the market is smaller. Silver is a $10 billion a day market. Gold is a $100 billion a day market. When the same institutional selling pressure hits a market that is 1/10 the size, the price impact is magnified. That is why silver went from 80 to 61, while gold went from 4,500 to 4,100. Same cause, different magnitude. And neither move has anything to do with the value of the metal. I have heard people this week saying, gold does not work as a safe haven. Gold failed. Gold is broken. And I understand why they're saying it. They watched gold drop 9% while bombs were falling. And they expected the opposite, but they are confusing 2 different things. Gold's long-term value as a store of wealth and gold's short-term price during a liquidity crisis. Those are not the same thing. The long-term value has not changed, not one bit. The short-term price is being set by margin calls and forced liquidation. And margin calls do not care about long-term value. They care about raising cash in the next 30 minutes. This is exactly what happened during COVID in March 2020. Gold crashed alongside stocks. Everyone said the safe haven is broken. Gold fell from 1,600 to 1,480. And within 12 months, gold was at 2,000 all-time highs. Within 2 years, silver went from 12 to 30 because the forced selling ended. The margin calls got covered, the cash was raised, and then the market looked at gold's fundamentals, the money printing, the inflation, the debt, and repriced it dramatically higher. It happened again in late January 2026. Gold crashed 21%. Silver crashed 47%. Everyone said it was over, and within weeks both recovered most of the decline, because the forced selling ended and the fundamentals reasserted themselves. The same pattern is playing out right now for the third time in this cycle. The forced selling will end, the repricing will follow. I do not know if it takes days or weeks, but I know the pattern, and the pattern has not failed once in this cycle. The third trigger is the Fed. The war has made inflation impossible to ignore. Oil above 170, PPI at more than double forecast, vegetables up 49%. The Fed looked at this and concluded that rate cuts are off the table. They signaled only one cut in 2026 instead of three, higher for longer. And when yields go up and the dollar strengthens, the opportunity cost of holding gold increases. Why hold a zero yield asset when you can earn 4% plus in treasuries? That is the institutional math, and it drove another wave of selling on top of the forced liquidation. But here's what the Fed math misses, and this is critical. The Fed is raising rates or keeping them high to fight inflation, but the inflation is being caused by $170 oil in a war. Higher rates do not lower oil prices. Higher rates do not end wars. Higher rates do not reopen the Strait of Hormuz. The only thing higher rates do in this environment is make the government's $39 trillion debt more expensive. Every rate hike adds tens of billions in annual interest payments, and those interest payments have to be funded. And they are funded by issuing more debt, which requires more printing, which is inflationary. Which means the very tool the Fed is using to fight inflation is actually creating more inflation on a longer time frame. That is the trap. And that trap is ultimately the most bullish case for gold that exists. Because a trapped Fed that cannot fight inflation without making inflation worse is a Fed that eventually loses control of the currency. And when central banks lose control of their currency, gold does not go down. It goes parabolic. That is what happened in the 70s. That is what will happen again. The question is not if, it is when. And the current crash is not changing that timeline. It is confirming it. Now let me give you the actual numbers because I think the data is more powerful than anything I can say emotionally. Gold has crashed 27% from the 5,600 high, 27%. Silver has crashed 50% from 121. 50% half gone in weeks. Those are not normal corrections. Those are once-in-a-generation discounts being offered on assets whose fundamentals have never been stronger. Let me put the 27% gold crash in context. The average annual return of gold over the last 5 years has been roughly 40%. So a 27% crash takes you back to where gold was less than 8 months ago. 8 months. The entire crash erased 8 months of gains. Not 8 years, 8 months. And the fundamentals that drove those gains, the debt, the inflation, the central bank buying, the de-dollarization, are all still in place. Actually, they are stronger now because the war added $170 oil and a trapped Fed on top of everything that was already bullish. Silver at 61 is even more extreme. Companies are producing silver at $12 to $15 an ounce. At $61, the miners are making $45 to $50 of profit per ounce. Record margins, record cash flows, and the stock prices of these miners have been crushed as if they are going bankrupt. They are not going bankrupt. They are printing money. At every price above $20, they are profitable. At 61, they are wildly profitable. The disconnect between the mining fundamentals and the stock prices has never been wider. And here's the data point that I think tells you everything. COMEX registered silver is down to 78 million ounces and still draining. Silver lease rates are still at 12%. Shanghai premiums are still in double digits. China is still hoarding before the April 1st deadline. JP Morgan pulled 1.6 million ounces from their vault last week. StoneX pulled 1.2 million. The physical market is still screaming shortage at the exact same time the paper market is screaming crash. And when paper says one thing and physical says the opposite, paper's always wrong on the long time frame. Always. Now let me tell you what is happening underneath the crash that the headlines are not showing you. While paper gold is crashing 9% in a day, physical gold is being accumulated, not sold, accumulated. The big players, the sovereign wealth funds, the central banks, the family offices with generational time horizons, they are using this crash as a fire sale. They are buying physical metal at prices they never expected to see again. The paper market is shaking out the retail investors, the minnows, the people who bought gold on leverage and cannot survive a 9% day. And the whales are picking up every ounce that gets shaken loose. I want you to think about what a whale sees right now. A whale with $1 billion portfolio sees gold at 4,100 and they check the fundamentals. Fed trapped. Check. 39 trillion in debt, growing by $1 trillion every 100 days.